What's up, guys? Welcome back. In today's video, we're going to go over one of my favorite strategies to use that I've been using over the past year that has generated me over 60K this past year. As you may see, you might be a little confused because I only have basically 38K right now. That's because these past 2 weeks have been pretty brutal, which I imagine have been pretty brutal for most investors. Um, thing I like is the three stocks I'm in. I love them. I am in good position. Is Snapchat, Hood, and SoFi. I own calls on Snapchat and shares on Hood and SoFi. So I did own calls on Hood, actually all of them, but they expired, and so they got a better break even for it. So now I'm kind of just waiting for them to recover a little bit. But yeah, let's dive into it. So this strategy, as you might see, is selling covered calls. Essentially, I love this strategy because yes, it limits your upside, but it also gives you a better break even, so it kind of has a layer of protection there. It's not as risky, which in my mind is kind of a happy medium. Obviously, I might lose out on some huge gain by a stock going from, in this case, Snapchat, $5 to $9 because I sold covered calls and um, it expired, and so I sold out at that price. Well, but in my eyes, we also don't know if it's just going to go straight up. It could drop down to $4 or $4.50. Well, then I'm in a better position than some of those other people. So this is kind of what my view on it. But yeah, we can kind of go through an example and see what you guys think. So the first thing is I typically like to do an expiration around 3 to 4 weeks. So other than I will say earnings, so like last week, Robinhood earnings were Tuesday, and so I would sell calls expiring this past Friday. So you can do weekly because the volatility is so high, and you can get really good premium for that short amount of time. But typically, not around earnings time. I'll do 3 to 4 weeks. So here we'll do March 6th as our expiration. Buy 100 shares of Snapchat $4.99, and we'll do a 550 call to kind of get our break even the lowest I kind of feel possible, because I'm not going to go ahead and lose money on it or do a $5 call. I do a $550 call because I feel the premium's high enough where I'm not going to do the $5 call, and but I also leave a little more upside with the 550 rather than a $5 call, or I get a better break even than a $6 call. So that's kind of what my thinking is I want the kind of the happy medium. And so in my eyes, a 13% return in 1 month is very good. As some of you might not know, typically you might get 10 to 12% in a year with investing in the S&P. So and this is in 1 month. So this would be, say, 13% in 1 month. That's more than what somebody investing in the S&P might get in a year. So that kind of gives you a perspective of how much this is, and in my eyes is super conservative and super realistic. That's kind of what my thoughts are. And then obviously you have the 485 break even, which is, I mean, I'd buy Snapchat at this price, let alone 485. So I'm trying to think if there's much else. I guess we can go through some examples of, like, okay, if somebody wants to do a $6 call instead of a 550 because they want to leave some extra upside, well, then you see that would be a 22% return, if that. But you also have a little higher break even than what you would have. I don't think this is a bad idea. I think you could do a $6 call. I would understand it totally, but it's kind of just what your preference is. If you're just trying to, like I said, a 13% month is super good. And if you're trying to get in and get out, well, then most likely it's going to fill that 550 call rather than maybe the $6 call. You never know. So I can understand it both ways. 22% return in 1 month is absolutely crazy. So obviously there's a lot to be made from this strategy. I don't really see much other cons than yes, you limit some upside, but I would do that for a 5 to 6% return a month, let alone a 13 or 22% a month. So that's kind of what my thoughts are on it. Is most people would tell you, or in the comments will probably be like, "Oh, why are you selling calls and limiting your upside?" Well, it's because I want to get a better break even, and also I'm fine collecting the 22% or the 13% in 1 month. I'm happy with it. I'm not trying to look for this huge gain. I'm trying to be consistent as possible. So that's kind of what I'm thinking. That's kind of why I love selling calls so much. And kind of just for some comparison, we can do a March 13th expiration and kind of just show what the difference is. So again, March 6th, it was a 13% return. March 13th, you're looking at a 14% return. So if you're thinking 1 week earlier, March 6th, that's a deal. Like, well, I'm not going to wait a week for 1% more. Or if we did the $6 call, okay, so that's 22%, March 13th, well, that stays the same. So, I mean, the break even goes down a little more, but I mean, March 6th makes the most sense to me. So that's kind of it for this video. Let me know what your guys' thoughts are on it in the comments. If you have any questions, you can put it in the comments and I'll try to get back to you. But if you guys could give this a like and subscribe, I would really appreciate it. But I hope I catch you guys in the next one.